This is Ralph Sass, and this is a continuation on job order costing and looking at cost flow and looking at some of the journal entries, what have you. This is from Chapter 3, but as I mentioned before, Chapter 2 and Chapter 3 really go together. And the other quick note is that Chapter 3 will be broken up into two parts. Okay. First thing to note is that when we go ahead and collect a sales order, what have you, that's going to be the basis for putting together that production order. And then that production order is going to initiate the job. Okay. And then notice what we're going to do. And let's go back to my building of a deck or what have you. We're going to go back and say we need not only the wood, but we also need some nails and what have you. When this occurs, what we're going to have to do is we're going to request some materials, and some of it's going to be for lumber, and some of it's going to be for nails and glue and what have you. So we're going to issue our requisition, and then what we're going to do is we're going to have some of it that's going to be going to direct materials, and that's going to go right on our job cost sheet. And then we're going to have some others that's going to go to indirect materials, and that's going to go into our manufacturing overhead account. So what we're going to do is we're going to have a manufacturing overhead account, and it's going to be a T account, what have you, and it's going to accept some of our journal entries. The same thing's going to apply to labor. Okay? The same thing is going to apply to labor. When the employee fills out their work, their timesheet, what have you, we're going to have some of that direct labor is going to go to the job cost sheet, and some of that ticket or whatever, and it may be different employees totally, is going to go to indirect labor, and that indirect labor is also going to go to that manufacturing overhead account. So once again, we're going to have things going to that manufacturing overhead account. So notice what we're going to have. We're going to have the indirect materials, we're going to have the indirect labor, and then other charges, the electric bill maybe, the depreciation expense, whatever. For depreciation expense, I should point it out. Depreciation expense for the production equipment is manufacturing overhead. Depreciation expense for the accounting's computer, that's going to be selling general and administrative expense. So it depends upon what type of what it is and what it's being used for. And so that's all going to go into that manufacturing overhead account. And then we're going to use the predetermined overhead rate to apply it to cost sheets. So that's what's going on. You're going to have to pay attention here in a minute when we try to realize if there is over or under applied overhead. So let's go ahead and take a look at some of these journal entries and see what's going on here for us. So we've bought raw materials. When we bought the raw materials are an asset. They're going to be on our that's an asset, and that's going to be on our balance sheet. Okay, and so then what we're going to do is when we issue that requisition and send the requisition, our direct materials are going to come out. Notice that's going to be a credit, so it'll reduce our amount of raw materials. And at the same time, our indirect materials are going to go over to our manufacturing overhead. So that's going to go to our manufacturing overhead. Now a quick note here, and this is how I remember it, and it's going to become important later on. When you look at the manufacturing overhead account, the actual amount is always on the left-hand side or the debit side. The applied side is always going to be on the credit side. The way I remember this is perhaps foolish, but it works for me. If I put actual and applied in alphabetical order, actual always comes before applied. So when I'm looking at my T account, actual goes on the left, applied goes on the right. So that's what's going to happen to my raw materials. And there's my journal entry. When I bought the materials, once again, I may have just paid for it, so that accounts payable may be cash. But if I haven't, if I have accounts payable with them, it would look like that. And that's a journal entry like we saw last semester in Accounting 1. Then notice what happens when we request the materials. Our raw materials are credited. Why are raw materials credited? Because they're going down. And our debit is going to be to work in process and to manufacturing overhead. Keep in mind, the same rules apply as last year. The debits and credit dollar amounts have to be equal. So that's going to be what my journal entry is going to look like. Notice since my manufacturing overhead is getting a debit, that's actual expenses. I do the same thing with direct labor. Looks just the same. My direct labor goes into my work in process cost sheet. My indirect labor goes onto my manufacturing overhead. Once again, it's showing up on the actual side because these are actual amounts that I paid. Okay, so that's how it's going to go through my T accounts there. And the journal entry there. Notice it's salaries and wages payable. Notice it's not salaries expense. My debit is not the salaries expense. Now my accountant, he's salaries expense. My company president, she's salaries expense. But the individuals that are working on the floor, they're either direct labor or manufacturing overhead. If they're direct labor, their expense is going to show up in work in process. If they're not direct labor, it's going to show up in manufacturing overhead. Ultimately, are they going to be expenses? Yes. They're just not going to be expenses yet. And finally, then I'm going to put my other overhead. When I have my depreciation or my electric bill or whatever, I'm going to go ahead and place that into the actual. Okay? Those will be my expenses. So I may have a journal entry that looks something like this. Accounts payable, I don't know what that might be. Maybe my electric bill. Prepaid insurance is a good one. Accumulated depreciation, only for the depreciation for the equipment that's in the plant. Okay, property taxes payable, whatever. And that's all getting debited into my manufacturing overhead account. Then what I am going to do is I am going to apply my overhead to work in process based upon my predetermined overhead rate. Remember how in the last chapter we worked to determine that predetermined overhead rate? When it comes time to assign it to a job, okay, I am going to use that predetermined overhead rate to apply it. So if on a particular job I worked 90 hours and each one got $5 an hour, I'd put that $450 into the applied here, and it would show up over there under overhead applied. Notice this is a credit, this is a debit. All is good as far as my debits and credits being equal. Okay, and so that journal entry would look something like that to get that when I figure out that amount. If it's the $450, oops, that's not what I wanted to do. If it's the $450, just to use the number I just had before, after I calculated it out, there's the $450, there's the $450. Debit to work in process, credit to manufacturing overhead. Okay. Now we're going to need to take a look for accounting for those non-manufacturing costs. This is going to be exactly like we did it in Accounting 211. Okay, salaries expense, advertising expense, what have you. Those journal entries are going to look something like that. Salaries expense, salaries payable, or maybe even cash. Advertising expense, here they have accounts payable. I'd argue it should just be cash. Let's just pay it and be done. But it would look something like that. Those are exactly the same type of journal entries that we studied in Accounting 211. Then, once I'm all done with the job, okay, notice what I have here. I have a job cost sheet. This is for, the SAS deck or whatever it is. Okay, I've come up with all my costs over here. Maybe $2,450. Okay, I've got to get it out of there. So since I look in there and I see the debit's $2,450, what do I credit it for when the job is done? $2,450, and I move it to cost of goods sold. Keep in mind, what does that do? It says my work in progress for the SAS deck is now 0. It's all done. Now I can put it into, completed projects folder or file or what have you. So that's what my journal entry there is going to look like. So there, it takes it out of work in process, gets it into finished goods, and then from finished goods, it's going to go into cost of goods sold. Okay, so I'm going to take it out of cost of finished goods and cost of goods sold. And now we're to the point where, if you'll recall from last semester, we may very well have two journal entries. Okay, why would we have two journal entries to record? One records the sale, one gets it into cost of goods sold. Okay, creates that income statement item, cost of goods sold. So for that reason, I may have two journal entries to record the sale and get it out of cost of goods sold. Now the problem. As you recall, we had that manufacturing overhead account. Okay, we had a T account. We had the actual amount over here. We had the applied over here. We were putting actual dollar amounts over here. Okay, we were applying it to jobs as we were going. And yeah, we're putting dollar amounts over there, but we had no idea if that overhead is right or wrong. Now it's the end of the accounting period, the end of the year, the end of the month, probably the end of the year, maybe the end of the quarter. Those two, the debits and credit side, will never be equal. I'd love to tell you, oh, they're going to be equal, but they're not. We are going to either have a situation where we have what we call underapplied overhead, i.e., we haven't put enough on the jobs, and that exists when the total amount of overhead applied, okay, is less than the actual. We didn't put enough on the jobs, okay, so our actual bills were bigger than our applied. Or we can have over-applied, okay, when the amount of overhead applied to jobs during the period is greater than. So what's going to happen is in one situation, the inequality is going to be that way, in the other case, it's going to be that way. And the question is, okay, now what do I do? So notice, their actual overhead for the year was $650 with a total of 170,000 direct labor hours worked. How much total overhead was applied for the year if they used $4 an hour? All we have to do is take the $4 an hour times 170,000 hours and we get $680. Now the issue. Oops, sorry about that. They've over-applied by 30 grand. So what that means is, if you took a look at their T account, the applied is over here, the actual is over here. They've got 650 in actual, 680 in applied, so they put 30,000 too much on jobs. The reason why that's so important is since they put 30,000 too much on jobs, that means their cost of goods sold is $30,000 too high. It's $30,000 higher than their expenses, so we've got to do something to get it down. Okay, so what we need to do is make a journal entry. So what we have here is another example, and once again, they had $1,200,000 in actual. The $4 an hour times the 290,000 hours is $1,060,000. So in this case, it's $50,000 underapplied. Now the question is what the heck do I do with this? Okay, and keep in mind, this goes back 2 items ago. I have a couple of different ways to do it. Okay, and your book will say it's an or, and it is. The absolutely correct accounting way to do it is to take the 30 grand and to allocate it between work in process, finished goods, and cost of goods sold. Because some of the amount that was over applied or under applied is in each one of those categories. Can it be done that way? And the answer is yes. Is that a lot of work? Yes. Does it lead to much better data accounting information? And the answer is not really. So the quick down and dirty way to do it, and the way I suggest you do it, is just take the 30,000, close its cost of goods sold, and be done. Okay, that turns that 30,000 either to increase or decrease the expenses depending upon whether it was over or under applied, and just kind of I'm done with it then. Okay? And maybe what I need to do then is to change my overhead rate to account for the fact that I've over or under applied my overhead. So notice here, we've got that 30,000 that is over applied. Okay? All we need to do is do the journal entry, debit the 30,000 to the overhead account, credit it to cost of goods sold. Notice what this does. I have over applied it. I've put too much on the jobs. I've got to get it off. Notice by taking that 30,000, I take this overhead account down to 0. But notice also, what do I do to my cost of goods sold? I reduce it by 30 grand, which is exactly what I wanted to do because I had $30,000 too much in expenses on that particular account. Now, the other alternative is to go ahead and apply it, and I am going to stop here and we will pick it up here on the next video.